Okay, thank you, Bob. Just one more sound check. Is everything coming through clear for you? Okay, wonderful, wonderful. Okay, so get the program, the slides working here. Bob, it went into Adobe Presenter. There we go. Good. All right, as Bob mentioned, I am from Hit the Mark Trading. I see a lot of few students in here and clients that I've had in the past. Thank you for joining today. Basically, I'm all about simplified trading. What we're going to talk about today is trend and momentum trading. And believe it or not, there's nothing proprietary that you need to get started. This is me in the trading room. It's a jungle out there, you see that. I want to again thank Trader Kingdom and Mirrors Futures for hosting this event, and I appreciate the commitment to trader education. Now, remember, we're all adults here, and trading financial instruments using contract stocks or options is extremely risky. Only trade with money you can afford to lose. Past results do not guarantee future results, and please consult a licensed professional prior to trading using real money. I really am big on this paper trading to learn new concepts, and that was drilled into me from a guy who was a hedge fund manager for commodities and 50-year trading veteran. And the guy still paper traded any new ideas, over and over. So regardless of your level of expertise, paper trade. Now, Bob went through my history. I'm not going to repeat this, but I will tell you in 2008, I did launch a Hit the Mark Trading, a teaching newsletter, like a mentoring style newsletter. And then I moved that to video. I think it was in 2012. They're now nightly videos. The Rooster Call is free. It's just my morning. I get up early and I look at the news, I look at the charts, and I just write something for the clients that we need to be aware of, okay? Sometimes it's nothing. Sometimes it's quite a bit. Sometimes I'll call a trade, but usually it's follow-up from the homework we've done in the nightly videos, so I share that. If you're interested in receiving this, go to my website, please, hitthemarktrading.com. Go to the contacts page and you'll find it. Now let's talk about what is momentum trading. Momentum trading is the art of spotting a market ready to move, selecting a trade, entering the trade with confidence, and utilizing predetermined exit points. Momentum trading builds off a firm understanding of support and resistance, along with known areas prices attracted to moving. Okay? Now, before I continue, I want to mention that I get so involved in these presentations, I don't look at the questions. So please hold your questions to the end. And one question for all of you in the audience, I'd like to know, are you a day trader, a swing trader, or both? So just put D for day trader, S for swing trader, or B for both. Okay. 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 All right. You got quite an assortment here, but a lot of day traders and swing and both do both, but a lot of day traders. Okay, good. I'm going to try to address both. Now, obviously, in 1 hour, I can't share what I would go over in 6 hours of the boot camp, but this is certainly enough to get you started. And I want to emphasize that I don't use anything special. I don't use any kind of the market profile, anything like that. I'm a very visual type trader. So in determining trend, the weekly chart is what we use to see the big picture. We use a daily chart for our tactical entries if we're swing traders. Alternatively, the intraday trader is going to use the daily chart for big picture, glancing at the weekly, and a shorter term chart for tactical entries. For day trading, as a general rule, the more volatile the market, the smaller the time frame. Now, markets can move in three directions, and so many times we forget this. Up, down, sideways. And if the market is sideways, we're greatly challenged unless the range is large. So it is imperative to find moving markets. I know there are some of you who only want to trade the ES. And I say, please, if you like your system and you think it's robust, I guarantee you it will work on other instruments and expand your horizon, okay? Now I'm going to use examples today from the Russell 2000, the TF. All right, we have to figure out how do we make it easy on the brain. So the first thing we do is we bracket lines with trend lines on the weekly, daily, and intraday. And here's a simple concept. Understand that price is going to bang back and forth between the price trend lines. Okay? If you can just draw these lines, now the slash line means I had a line here previously. And just understand this is a weekly chart. Just by simply drawing lines, we kind of frame the action. We make it easier on the eyes, okay? Don't worry, I'll introduce the oscillator in a moment. Meanwhile, I do use the moving average. It's a 34 exponential. Here's the daily chart, okay? Again, it's just wonderful to me, the idea that I can map the road out and just see price banging up and down, okay? That's tremendous in trading. All right. What's the rule? A channel line holds until it doesn't. Nothing complex here. Here is a day trading chart, 10 range bar chart. Now, on the Russell 2000, I like the 10 range bar. For years, I traded the 512 tick. I love the 512 tick. For years, I traded the 3-minute, and I decided, you know what? I got to have something based on activity, not time. Okay? So I don't use the minute charts anymore. Now, support and resistance is huge in momentum trading. It really is, especially day trading. So learn to identify probable areas price wants to touch over and over again. All right? Now, we're going to talk about an oscillator. And here's what you need to understand. Oscillators derive their power from price movement. So for this reason, you really need to understand how to read the price action at support and resistance areas. When we initiate a trade on corn or cotton or ES or Russell 2000 or anything, we already know areas where price is likely to move based on support and resistance, okay? Our oscillator provides a trigger point. Now, new traders ask which oscillator should we use, okay? And for a lot of new traders, it's just, they look like this. What? Okay. Those are my chickens, by the way. So tons of oscillators exist out there. Everyone has a personal favorite. There are so many people that are going to try to sell you a proprietary oscillator. And I'm here to tell you, I've been at this for quite a while. And as long as you know how to use something that speaks to you, that's all that matters. Because in a moving market, everything works. Everything. It doesn't matter. Everything works in a moving market. It doesn't matter. Now, in the beginning years, I used slow stochastics. I used MACD, Williams percent R, and the RSI. Maybe had the Bollinger Bands. And boy, when everything lined up, go on a daily chart. At present, I'm just using one indicator after many years of trading and my desire to simplify. So I use the Commodity Channel Index, also called the CCI. And what's interesting is, I'm just like you. I'll hear something and I say, maybe I'll look at that. And then I put it right up against the Commodity Channel Index and I see, well, hey, there's no edge here. Why am I looking? Haven't I beaten that out of myself? Just relax. Again, here's an important point. In a strong momentum market, all price oscillators work. One time I gave a presentation, and I just, like a flip of a coin, I just threw the 21 and the 7 simple moving average on an intraday chart. And guess what? In a moving market, it worked. I'm telling you, everything works. In a tight range market, tight range means price is not moving that much. Guess what? Your favorite price oscillator loses its predictive value. As long as you own that concept, then you're going to want to dig a little bit deeper and say, maybe I should look at markets that are moving. Maybe I want to look at the cotton market. Maybe I want to look at the corn market. What is moving out there? Okay, one more reason to monitor several markets. Now, what is the CCI, Commodity Channel Index? It's a price oscillator created by Donald Lambert. I met Mr. Lambert. And basically, in a moving market, the CCI is shown to lead price. I don't like you to take my word for this, okay? You check out John Murphy's take in his book, Technical Analysis of the Financial Markets. The guy devotes maybe a page on the CCI. And what's interesting is he says down here, let me get my pointer. Oh, hello, pointer. Notice that the CCI turns before prices at each top and bottom. The default length is 20 days. Okay, notice that the CCI turns before prices at each top and bottom. So here's the CCI right here, turning down below this 100, and boom, price comes down. Here we are turning up, price goes up. Turning up, price goes up. So this is very simplified, extremely simplified, but this is the crux of the CCI. Now, it's an oscillator. All you need to know is that we are comparing price with a simple moving average over a selected time span. Mr. Lambert suggested a 20-day period. Others have modified Lambert's suggestion for intraday using 14, 6, and 5. The other day, I got some kind of I'm on everybody's mailing list, it seems, and I got something where, just to be different, someone throws a 30 CCI. So just to be different, just to look like they know something a little bit more than the next guy. Now, how do you calculate this CCI? Well, thankfully, most software platforms have this task automated. All you do is you define the time period. So here's the calculation. You can study this on your own time. I look at stuff like this and I'm reminded of why I did not go into a mathematical science type field. Okay? All right. Now what you need to know, CCI is plotted on a histogram. I will show you that in a chart. The zero line represents major support and resistance. The 100, minus 100, the 150, and minus 150 represent minor support and resistance. Here we go. So this is a Russell 2000. Don't worry, I've got today's chart coming up soon. But basically, the zero line is major support and resistance. Okay? In other words, it's meaningful if we are seeing the 14 on an intraday. If we see the 14 above the zero line, we get a bias for upward action. If we see the CCI below the zero line, we have a bias for downward price action. Now, look at the 100 line right here. That'll come into play later in this discussion. This is minus 100, this is plus 100. 150 is key for us. You'll understand why in a moment. And a 200 would simply represent extremes. I'm not locked into this 100%. I'm always looking at the price action. What at the end of a day, what is oscillator really do? The oscillator simply gives you confidence of what you intuitively see on the chart. Okay? Let's go. Now, the diagonal trendline break is all I'm going to talk about today. There are certainly about, 5 different patterns I trade. But if you're new to the CCI and you just start focusing on a trend trade with the diagonal trendline break, I'm telling you, you should be able to see an improvement. Okay? You should paper trade it. If it speaks to you, it's probably going to speak loudly. If you can't get over the simplicity of it, you're not alone. It took me a year to convince myself I would print the chart off every single day, black and white, and take ruler and pencil to prove this to me. For a year I did this. And then it's like, you know what? This thing works. So understand that we want to start drawing our line from the plus or minus 150. Okay? As a general rule, the higher you draw the line, when it's broken, as a general rule, we expect good probability of follow-through. If you look at the CCI and you cannot draw a trend line, do you really want to take the trade? Let me show you what I mean by that. Okay, here's the weekly chart. So, weekly chart. Now, the moving average. The way I have this moving average, it changes color. Blue is up, red is down. Okay. I give these templates out to my paid clients for free. I don't nickel and dime people. And so basically, when we see that we're in an uptrend, both by the moving average and by drawing our simple lines here, okay, when we see we're in an uptrend, then look at our little diagonal trendline break. So look, diagonal trendline break, up we go. Diagonal trendline break, up we go. Diagonal. So on the weekly chart, if you see this, then you should know that your daily is going in the same direction, right? Let's look at the daily. Okay, the daily chart, if your weekly is going in an upward direction, then the daily chart, you should know that anytime you get a trade coming, a signal, in the direction of the weekly, you're going with the larger trend. Okay, I have somehow lost my, there it is. Here we go. So, we've already established we have an uptrend. Diagonal trendline break, up. Diagonal trendline break, up. Diagonal trendline break, a couple of them, up. All of a sudden, an event. We fall down here. Now, this is likely something to do with a central bank or something, okay? Because I remember that the market got skittish there. I also look at seasonals. We'll talk about that when I show you the cotton chart. Now, when I see price start hesitating, that's important. So draw that line because it's going to probably come into play in the future. All right, diagonal trendline break, up we go. Hey, back into the channel. That's always a strong signal. Because where do we go? To the top. How do I know? Because that's what price does. Do not overthink this business. This is not rocket science. I bang up, down, up, down, up, down, up, down, up. Okay? Do not overthink this business. Okay. Suddenly I got a change going on here. It looks like diagonal trendline break takes me down. Oh goodness, we touched this line again. This is how you develop your trader instinct. Okay? Let's move on. Now for intraday CCI, you're going to, same methodology, we go to the 14 instead of the 20. This is the key. Smaller time frames in moving markets with good range. If you have gotten yourself beat up, cut up, because equity index futures are not moving, you're not alone. But how many times are you going to go through this before you decide, hey, maybe I should look at some other stuff? Because I like my methodology. Maybe I should put this on. Gee, it looks like wheat's going to move, or it looks like corn's going to move. Hey, those are massively liquid markets, especially corn. Okay? All right. Now, I do use floor pivots. They're just called pivot points now because they've eliminated the floor. But I do use the pivots. It's a big deal, a huge deal. Trade the rush hour instead of all day, and this means the first hour and a half of trading is always going to be your best. And then there's typically a rush hour in the afternoon. The objective, keep your brain fresh instead of bored. That's the objective. I'm through with those days of sitting at the computer for 6 hours, making money in the morning, and giving it up over lunch and afternoon. It's not worth it. Learn to trade the rush hour, and then remember there's a life outside of the trading room. Okay, now here's today's chart, 10 range bar chart. The 512 is good too. I also use this on the Euro. 512 is good on Euro. So if you are not comfortable with range bars, or your provider doesn't have it, the tick charts are good. Remember, if you have any questions, hold them to the end. I'll answer them. All right, now what I've done here is I've drawn these vertical lines to show you entry signals. And I want you to pay special attention over here to the right. And I'm going to blow these charts up, okay? But I just want to get a big feeling for what's going on first. So the reason I say watch this to the right, because as I'm creating this presentation today using live charts, this trade triggers. All right? So let's go over this. How simple do you want it? Diagonal trendline break. We go up. I'm going to talk about protective stop. I'm going to talk about exits. Right now I'm just showing you diagonal trendline break. Notice the green line is the 150 line. So you draw it from here or higher. Okay, now we've been kind of going down, 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 down. And then all of a sudden we go into this kind of a little congestion area expected because of FOMC day. And then pop goes the weasel up and then down. And this is all called the initial action and then the reaction to the action. So I took an extra long lunch day yesterday. But I was back in time because I knew the market was going to move after this report. So we see that we started a new trend. Diagonal trendline break takes us up. Diagonal trendline break. If you didn't get in, you got another chance. And up we go. Diagonal trendline break, up. Okay? And this is what happens. This is what we do. Okay, now here's today. Okay? All right. So it looks like we were up and then we changed trend here. Now what's important here, no audio. No audio. Shoot. No audio. Let me send a note. Okay. Good, good, good. Okay. Super. All right. Boy, I get on a roll, don't I? Here we go. Now, I want to back this chart up. You know, I put out a few, thank you, Mitch, appreciate that. I put out a few YouTube videos showing how to prepare for the next day trading on the TF. So if I'm drawing this line, and it's broken, it's meaningful to me. Right? And so the line was broken this morning. And guess what? We start a new trend, a downtrend. Right? Now, let's go on to the next chart. Here's that line again. Broken. And we start a new trend. So diagonal trend line break, that means I get in here. You'll see where to put your protective stop. Don't worry. And you'll see that we don't get taken out by this bar here. And so if you just went just to this point right here, and I'll tell you why we would get out in another slide. We got a signal to get out. Well, that's 150 bucks. I know a guy who trades 10 contracts, and all he does is look for 10 ticks. That's it. He has $1,000 a day, more than anybody I know. I got other people that will hang on looking for the trade of the century every single day. And they get so upset. All right, here's another one. Diagonal trend line break. It's with the trend, right? Boom. So there's your entry. Don't worry, I'm going to show you exit and I'm going to show you protective stop. Now, why would you exit here? Well, one reason is you figure this is the new line. As long as I've got 3 touches or more, I'm going to just extend that thing out. So if we know that more often than not we hit it and pop higher, it's a good area to take profits, don't you think? You can always leave a runner to capture more gains. Now, it's interesting, the concept of runners. I believe you're going to find greater satisfaction if you can trade at least 2 contracts. Now, there's been some days where I should have been all in, all out. But if you want to try and capture the bigger runs, leave one guy in the back while you take profits, and your runner, you're going to sacrifice that, at break even +1 or something like that. That's another topic. All right, so here we go right here. Now, this is that trade, the right edge of the chart I wanted you to watch. So we got our diagonal trend line break with a trend trade, and just watch what happens. So just at this point, just to the edge, is 120 bucks. Whoa, my goodness, hello. I thought I said the trend line hold, the channel line holds. Well, boom, it went lower. So now all of a sudden, getting in here and holding that runner is $480. Right? And I'll tell you the exit a little bit later. If you just held from here down to here, 240. Now, I have gotten over trying to squeeze every nickel out of the trade. If you're a day trader and you got a contract and you got 400 bucks or something like that, hey, that's good enough for me. So I really don't try to, and I don't want to imply that I am so smart that I got out at the very best. I'm just showing you how much the run was. Okay? All right. Now, there's several patterns for profit. I want you to start with the diagonal trend line break on the CCI with the trend. Okay? There are certainly others that I take. 90% of the patterns are going to be the diagonal trend line break and another one called the failure swing pattern, which was first created by J. Wells Wilder Jr. on his RSI. Here's your key point to remember. Draw your line starting at plus or minus 150. Better trades are in markets showing momentum. We use the 20-period CCI for daily, weekly, and monthly charts. Monthly? Yeah, I'll look at that once a month. Big picture. Use the 14-period for any time below 60 minutes. Okay? Or if you're using volume charts, you're going to be using the 14. Volume, tick, range. Rinko's just the former range bars. Now, entry rules get you started. We've talked about diagonal trendline break with the trend. I'm going to show you now protective stop. We're going to place the protective stop above the trigger bar if we're going to go short. On a daily chart, we're going to place a protective stop below the trigger bar on a daily chart if we're going to go long. Intraday, now this is the big deal here. You put your protective stop below the bar preceding the trigger bar if you're going to go long, or above the preceding bar of the trigger if you're going to go short. So here we are. Let's look at this again. Today's range bar chart, I think this is. Let's see here. No, this is not. This is just to show you. Okay. Let me get to today's chart. Well, I'll show you on here. I thought I had this marked. So let's just look at this. Here is a trend trade. How do I know it's a trend trade? I don't have any lines on here. Well, now I'm working off the moving average. So diagonal trend line break. This is my trigger. Protective stop. You're going to put that protective stop at the bar preceding the trigger. Now, you look at this, it's right at the same level. Okay, well, come on, let's be common sense here. We're going to put it below this guy. And this is the best protective stop placement I've ever thought, I've ever found. And again, this was taught to me by the guy who traded for 50 years. Diagonal trendline break, here we go. Protective stop would be down here. Diagonal trendline break. Where? Here. This looks like for a downside move. So the counter trade, see why you don't like counter trade? You got a signal here to go short, but gosh, it was hardly anything. With the trend trade, okay, protective stop right up here. And look at how we go down. Diagonal trendline break, here's the trigger. So go in the bar before. Okay, get used to this. Diagonal trendline break. If this is the trigger, put it right before. All right, I think you get the gist. Why don't more people use the CCI? I'll tell you why. Because people have successfully marketed other complex stuff, and especially proprietary stuff. All right, I will go to the questions at the end. Now let's look at protective stop again. Place your stop below support if going long, right? Or below the trigger bar low. Now what do I mean by that? Now suddenly I've got it conditional. This or this. Well, what this means is if you have on a daily chart your trigger bar but just a little bit lower is major support and you're going to go long, I mean, exercise some common sense and put it just below support as initial stop. You can always move it later, but as initial stop. Okay. Place your stop above resistance if going short or above the trigger bar high. Intraday, again, this is a big deal. We're changing here. Intraday, you go to the bar in front of the trigger. I guarantee you, if you focus on your protective stop and honor the protective stop and never ever expand the protective stop, you'll be writing me thank you notes. Gosh, this is great. I don't lose as much. Because when we move our protective stops, we're in hope mode. All right, here's a 10 range bar chart. And let's see here. In the day trading, if the Russell 2000 is trading less than a 2-point range, hey, I'm not interested in that. Not at all. Why? Because the minute you try to say, okay, I'm so bored, I know what they're going to do. Right? So let's say you decide that you're going to get in there because you know it's going to go up. By the time you get in there, they've already slammed it down, and that's the moment they drop it. So just wait and be patient. You got to be patient. All right. So, this shows you protective stop on this trigger. Okay, this is the slide I was looking for. Here's protective stop on this trigger. 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 And what that means is if price starts shooting up, you basically throw in the towel. You wave the white flag. Instead of saying, no, it's going to come down. Exits. All right. I know I'm going fast here. I will answer the questions. We got profit targets like my friend who he makes $100. He's trading 10 contracts. And you talk about a happy guy. Okay? If the CCI has been up above 150 and it starts turning, crossing the 150 toward the zero, this is your first shot across the bow. This is the first warning signal. Hey, momentum leaving the party. If the CCI crosses the 100, you want to be out. Absolutely. Price touching a floor pivot. That's a great exit point. And I do extensive work with floor pivots. Price touching the 34 EMA. Now that's what I use. If you are married to the 20 EMA, I have no problem with that. My big deal is that you work with what speaks to you. If what you're working with does not satisfy you, then I want you to try some of my stuff. Price touching a channel line. Gosh, I can't tell you how many times that comes true. So there's all types of exit rules for you when you're trading. All right? This is big, the floor pivots. Now, today's chart. Okay. So let's just talk about let me get my bearings on this. Diagonal trendline break. Say go short. Protective stop would be just above here, right? So You get in that trade, and the first one goes against you. Maybe you got knocked out, maybe you didn't. And of course, it's consternation. We know that. But what's happening? The trend is changing. But then, once we get that first touch up here, then it seems like the trend is confirmed. And we're rolling. We're rolling. So, what many people have found using this system is that we don't have, and of course you need to prove this in paper trading, but it's rare to have more than 2 losses in a row. Okay, I can't guarantee that because everybody trades differently. But how many times have you gotten discouraged? So what happens is, as you prove something to yourself and then you experience a loss, you say, you know what? Hey, this thing, all my testing, we don't have more than 2 losses in a row. If you do, then you're either trading a sideways market, a tight range, or there's something wrong. There's something distracting you. You're reading something. You're talking. You're chatting. Okay. Now let's go over here. Diagonal trendline break gets us in. Okay. If we got in on this trade, the CCI crossing back above the 100 tells us we got to get out. And that's an exit. Diagonal trendline break here. We take the short. Where's our protective stop? Right here, right? You got that? Does that make sense? This is going to save your bacon. Now, we're going along with the trade, and all of a sudden, we've crossed the 150. This is the first warning signal. Downward momentum leaving the party for a moment. And then the next bar, we go over the 100. This gets you out of the trade. Simple. Well, what about the guy who took targets on the channel? Right? The guy is happy. That same guy over here says, wow, I should have held. Well, you can't have regrets. You got to just have a plan and be positive. If this is what you're going to do, then you simply exit at this channel line. In the bigger picture, what is price doing? Going down to the main floor pivot. That's what happened. All right. So let's go again. Diagonal trendline break. Now this is something we'll trade here. This is something we'll trade. I'm not going to go into it, but this is like it's a big deal. Otherwise, diagonal trendline break is right here. We would have got in probably 1 bar earlier. We're in the trade until when? Well, when we cross the 150, minus 150, that's the first shot across the bow. It says, hey, do you want to take profits here? So that's a $200 move. Or if you got up here, probably $100. Here's crossing the 100. Okay. Now, we just went into some chop. Run back up, and then there's another signal to go short right here. Where do we put our protective stop? This guy. Or you say, well, heck, this is just so close. I'll just put it up there. That's what I do. And you're just saying, wow, look at this trend. I caught the trend. Okay? So the guy who had a runner from over here is just happier than a pig in swill. Otherwise, people who are taking the scalping, these smaller moves, are doing quite well. Where do we get out? Well, here we are. our first green bar, and it just happens to be when the 14 period crosses the 150. This is your warning signal. Hey, not so fast. I might want to go higher. And then boom, confirmed it. So if you did not get out down here and you got out on the exit, you made $110 on that trade. Or from way up here, you get out at that exit, you made $350 instead of, what was it, $480 or something like that, $450. Okay. Bottom line is, you're not looking at order flow. You're not looking at you've thrown all that stuff out, and you're just being very visual. A lot of people cannot handle being visual. They are more analytical. Daily Russell 2000. Goodness gracious. Okay. Diagonal trend line break. Now this is a counter trend trade here. Right? We go down. Once I get this business and this business, I can start my line. Diagonal trend line break. Well, I've touched more than 3 bars. Boom, we go down. Diagonal trend line break, daily chart, up we go. Where's protective stop? Below your entry bar. Diagonal trend line break. Boom. Trend trade. You know, I mentor people, and I cannot tell you how many people have the most difficult time releasing themselves from the shackles of counter trend trading, because they know what's going to happen and they project, and I'm telling you, they get just absolutely beat down on the counter trend trading. And we work together, and they see the benefits of trading with the trend. And then I always say, hey, once you are successful trend trading, then you play with the counter trend. And they leave, and then all of a sudden I hear back a month later, and it's just awful, because it's very difficult to form new habits. Okay? So just keep that in mind. Momentum traders believe they're in for the long haul, taking a series of trades, converting to cash quickly. And I don't care if you are a day trader or you are an option trader trading stocks. Runners are for longer term moves if that's your style. Trade multiple contracts rather than pin your hopes on a single contract. Paper trade prior to using any real money. Understand your ego and your mind, and trade with your weakness in mind. Your weakness is your reminder of what you must avoid. So if you're the type of person who says, you know what, why did I think this was going to go in my direction longer? You need to address that. You're living on hope. Okay, mastering any trade, you got to do the same thing over and over again. It's got to be, quite honestly, predictable. Okay? You don't think about tying your shoes, do you? You did it enough that it's predictable. All right? Now, I want to talk about this cotton trade, then I'm going to get to your questions. I just want you to see how I analyze a market. Weekly cotton, this is seasonal studies down here. Yes, I look at seasonal studies. Now the thing about seasonal studies is, it's more of one of those things like a tendency. So the best part about a seasonal chart is the top, the very top, and the very bottom. That's what you want to really watch and focus on. All of this stuff in the middle is just, I don't know, throwing the dice. But what you want to do is really look at the focus on the bottom and the top. So what this tells you is if we see the seasonal tendency is for price to go down, then we look for a technical reason to take a trade in that direction. And since we're looking at seasonals, we might as well look at, well, hey, what is going on in that market? Because you're not going to just approach the cotton market having never traded it and not, try to learn a little bit about it. So what you find out, what we found out, is that not only do we have the seasonal trend showing up again, now look how this thing's worked. Down, 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 down. Over here, down, ooh, big time down. But we also find out that the weather is going to be great. That's all bearish for cotton. So let's look at the daily chart. Well, here's our line. It's a kind of a big deal when this thing's broken. We have a support here, strong support. And I'm telling you, we stalked this trade. And it was just absolutely frustrating, right? Because you're looking, you're saying, well, wait, seasonally I should be going down, and well, nothing happened. Because the channel line is so strong. So I have a rule. 3 closes outside the channel line. And then what that does is help avoid fake outs. Because more often than not, you get 2 closes outside the channel line, and you get in, you're excited, and the next day, boom, back in the channel. So we actually had a diagonal trendline break here. But, my gosh, what a trend was. Oh, my goodness. Who's going to fight that? I want more evidence. So I want 3 closes out, and boom, here's where we got in. We got in right here, 91.55. And, I'm big on, I just want to know. I want to know. Where is support? So protective stop on this was just above the moving average, right? And then, my goodness, the seasonals worked. And oh, it was just wonderful. And of course, we're watching this, we're keeping the protective stop up there. And all of a sudden, as this thing starts going in our way, our direction, and we know that cotton can be wicked and give you these big old wicks like that, and just, next thing you know, it's like, what? You're knocked out. So we had to have a generous stop. All of a sudden, we start getting profits of $2,000, and we start tightening up. All right? And the thing went, when we hit 3,000, I issued it. It's almost like, how good does it have to get? How good does it have to get? But we put our protective stop to knock us out, making 2,500. So anyone who simply said 3 grand's a great deal, wonderful. Otherwise, everybody got knocked out on this bar right here, 2,500 bucks. And this is how we look at things. This is how we look at things. Now, did the CCI give any kind of signals? Well, again, cotton is kind of it's a nervous little animal. But here is well, you got this crossing the 150 would be, I guess, where this green bar is. And then here's crossing the 100. We also, at the same time, had a trade going on in corn, short in corn. Okay. Now, there are certainly other things I use to build up our probability of follow-through. But again, in a session like this, I mean, I'd be here forever. For new people, keep your trading simple. Block out distractions. Become as mechanical as possible. Taking a few moves that setups that prove consistency. Now, you've got to do this. You got to do it on paper. Forget about the experts, and you develop you as your own expert. And that means, test everything. All right. For me, simple works best. Support and resistance is big. Moving average, an oscillator, floor pivots. Forget fancy. Forget latest and greatest. Most of the professionals have an understanding here now. Most of the professionals are using extremely simple systems. All right. I'm ready for the questions. And while you're putting your questions in, I want you to know that this is a good deal here. It's free. Free is always good. So you can sign up for Rooster Call and you can see what my interpretation of the morning. Okay. Then Hit the Mark Trading is a nightly video Monday through Thursday, and then the weekend I do I look at the weekly charts. And basically I call trades in advance, and the idea is you watch the trades unfold, okay? I call it in advance so you can see if there's anything to what I do or if it's all just, I don't know, talk. I don't believe in that. It's all action. You practice. This is the only way you can take ownership. And a lot of people will say, you know, I tried CCI on the intraday and I couldn't get it to work. And then you look at the chart. Well, wait, show me your chart. And they're trying to trade such an extremely tight range, and they're just getting chopped. So you really need to pay attention to identifying a range, okay? A tradable range. So for Russell 2000, I wanted 2 points, greater than 2 points. Now the momentum boot camp is 6 hours. That's 6 hours. It's big. So if you want to tear down what's not working and build yourself up, we start at the very basic. And we build and we add, and then we talk about nuances. We go through the different patterns, and we have a special filter we use. And if you noticed on my charts at the top right hand, I'm measuring the angle of the moving average. That's just something I do. But it's not required if you're just learning this stuff. If you can't make a boot camp, I got the video recordings. It's just like being there. So the next session is, next week. And I'm going to do another one at July and another one August 2nd. It's Saturday all day. Okay, now, I just paid a guy to haul off I had the trees trimmed. And I just paid a guy $225 for about 4 hours of work, I guess it was. Something like that, right? That was an exception. Most of the time, this yard work stuff is big money. So when I think about 6 hours for what can help you in your trading business, I think it's an extremely good deal. The website has more information. Now, let's talk about questions. What do I consider a tight ranging market? Good question. On the Russell 2000, if you're a day trader and it's moving in a tight range of 2 points or less, especially, in the pre-market, you need to wait. Let that thing settle out. Or over lunch sometimes it trades tight. If you look at a daily chart and you see on the daily chart all these small bars, okay, very tight, that represents bulls and bears are in a tug-of-war and no one is really gaining. So they're keeping the range tight because as soon as someone tries to buy, someone's selling right on top of them. So you look around and you say, well, this ES is just not doing it for me. So maybe I should look at gold. Maybe I should look at corn. Maybe I should look, and you practice that. Okay, but the bond market, my goodness, bonds can move fantastic. And if you are worried about the tick value on bonds, 31.25, I think it is, go to the 10-year note. Why don't more people use the CCI? Because most people are not willing to stick with one thing. They try it, and they just can't stick with it. And that's human nature. Everybody wants instant gratification. So they go to some guru who's going to sell a program. Or they're going to go to somebody who's going to teach them how to look at order flow and volume. And if that speaks to you, it does not speak to me. But the something about the CCI is so ridiculously simple that people have a hard time with it. And that's the truth. Okay. Do we learn to put orders in, or just the theory of trading? In the boot camp, you're learning how to read the charts, and you're learning where a buy signal is or where a sell signal is. And then the nightly videos, the boot camp comes with a free month of the newsletter. So then you're learning, okay, we've got a setup here. For example, we had a setup on a stock, ready to go long, buy options. Well, the thing gapped up today. So our analysis was right, but the stock gapped up against, it moved too fast. So we're learning how to read the charts to tell us what to do. Sometimes when we talk about stocks that are moving sideways, then we can put on a non-directional trade. Or if the range is wide enough, then we can buy at the bottom, sell at the top. Because our rule is the channel line holds until it doesn't. What is the moving average on this chart for TF intraday, 34 EMA? 34 EMA. Okay. What is your criteria for drawing your trend lines on CCI? It appears to be from low. Okay. You want to draw it from at least 150. And what you want to do, let me get a chart of this. That's a good question. Okay, right here. When you're drawing their line, let me get my pointer. Okay, you want a bump. You want to touch one bump. Okay, so I would have had a line drawn here first. And then this line, I'm touching a bump here. Let me see if I can show that on a better chart. Okay, good, perfect. All right. I'm going to draw the line from 150 or higher, and I come down and I touch it right here. And I just extend it out. So I'm not drawing it until I touch here. Okay. Over here, I would have had a line drawn like this. Let me see if I can do this. Here's the first line. Come on, get down here. That's my jagged line. All right, so the rule is, let me get rid of this pencil. The day that I become emperor of the world, I'm going to make everything thought controlled. Okay. I can't seem to do this, but notice here we got a line right here, okay? A touch, I'm sorry. So we start drawing it here and we have a touch and we just extend it out and we wait for it to break, and then boom, up we go. Okay? All right. There we go. I got rid of it. Why are you using both Trade Navigator and NinjaTrader? Because sometimes I do presentations for NinjaTrader. That's the only reason. I have my template for Trade Navigator. I have a template for NinjaTrader. I have a template for TradeStation. I have a template for Thinkorswim. Why is that an important issue, I'm wondering? Okay, as a 14 as opposed to 20, what is the time frame? Ticks, minutes. So the diagonal break at the bottom correlates with diagonal directional price change. You're going to have to it's a good question. You're going to have to work with it, and the guidelines I'm presenting to you is that when you are over 60 minutes or higher, then you're going to go to 20. Below that, use 14. If you're using tick charts, you know those move faster, right? If you know, like a 512 tick. So use the 14. If you're using volume, like 250 volume or 500, use 14. Okay? Now, a lot of times when I'm looking at a new market to trade, and I'm trying to figure out, well, hey, what should I be doing on this, the ticks here? What I'll do is I will just say, well, I'll just put different time frames up, and I say, okay, which time frame seems to give me the good patterns on the CCI? And what I've basically done is I'm using the 10 tick on the ES, and I'm using the 10 tick on the Euro. I use the 10 tick on the CL. Okay. Sometimes I'll drop that to a 5 on the CL. Now, if I'm looking at the CL, and I do trade at Mitch. If I look at CL, I'm also looking at, and the periphery, 15-minute, only because I want to know. I want to know, okay, I'm so focused on every tree like I've got a machete in my hand. But how big is, what's the direction here? What's the bigger picture? So before the day trading starts, the daily chart tells me, and if I got a CCI signal on daily chart saying go long, I'm expecting that more often than not the day trading is going to be biased to the upside. Anything can happen. And then as I'm trading, I'll look at that 15-minute crude chart only just to in the periphery say, okay, nothing's going on here. What's 15-minute telling me? That kind of thing. All right. What type of recommendations you make in your option letter? It runs the gamut, Lyndon. It could be non-directional tradings, which they can be a nail biter, okay? For example, we had a trade in FFIV, and when things looked like they're going rough, you know, we took profits a little early, but some people held. And all of that came home today for them, big time, because we sold the 110 call short. But we will do non-directional trading. We'll do vertical spreads. I will do lottery ticket trades. What the heck is that? Well, we have a trade right now with CLF, and it's going out using leaps, options that are good for January 2016. In other words, we think that buying options on CLF, which are trading, the stock's trading below book value, and we got 2 years for some kind of economic recovery to occur, a meaningful economic recovery. Well, any economic recovery is going to have to use iron ore, so CLF should benefit. We've done that trade before. We're doing it again. On the option course, David, I'm got that all recorded. It's all recorded. So if you were to purchase the option course, then you're going to go through the recording lesson. And of course, you've got access to me on any of your questions, send charts, all that stuff. How can I get the 10 range bar chart time frame? Your chart provider should have that 10 range bar. If not, you might need to ask them about it or go with a different provider for your data. Please indicate precisely how diagonal trendline break relates to the price chart. Thanks. Okay. Let's look at this daily chart. I got it here. Remember, the first one we would draw it right down here. But let's look at just this one. All right. First, you note it's a trend trading, right? Trend trade. This is simply telling you diagonal trendline break. Take the trade long. And it's this big candle right here. Where are we going? Right here. How do I know? Well, I don't know. It could go just soar up completely higher. But at some point, you know, when you do this so many times and you see that you just draw that line and extend it out, and it's a barrier, it's a boundary. It's like keep it all within the lines. Okay? So the next time, if I ever get to the bottom and start going up, I already have a target. So boom, diagonal trendline break, up. Diagonal trendline break, right? Up. Why can't we break through this? I don't know. But we certainly broke down. So this is one of those patterns that, this is the failure swing actually. And it's a reversal. And so boom, back in here. Price wants to resume the trend. Okay. 10 range bar. The 10 range bar means that there's 10. All right, there's one tick is $10. So a 10 range bar is 10 ticks. So one bar is $100. Okay. You're welcome, David. I appreciate you being here. All right. Are there any other questions? Any other questions? Gosh, we've gone over. I appreciate your attendance today. And you're welcome, Mark. I would love to show you everything and simplify your trading. You're welcome, Rick. Thank you. Please consider the boot camp. It's oh, thanks, PK. Good courses made me bucks much. Thanks. Appreciate that, PK. I just can't tell you how I've gone through everything, and I've been in everyone's shoes, and it's just been frustrating. And then all of a sudden, it's like you say, well, there's a life outside of the trading room. I need to simplify. And then you find that these big multi-million-dollar funds are trading what? Moving average crosses. Something so ridiculously simple. And I go into a lot of that in the course. So I'll talk to you later. Bob, I want to thank you for allowing me to speak. Appreciate your dedication to the trading education. You guys are just great. I know it cost a lot of money to hold this platform and to send out and have people send out the notices, and you store all these videos. I think it's a tremendous service that you're giving traders for free.